All right, let's dive right into this explainer. Today, we're looking at a legacy company that, honestly, most of us probably still associate strictly with glass, Corning. But we aren't just looking at glass today. We're actually tracking a massive, kind of wild transformation happening right in front of us. I mean, with a 17% jump in core sales and a 30% leap in earnings per share, this company is riding the AI boom in a way almost nobody saw coming.
But hey, we aren't going to start with the final verdict on whether the stock is a buy or not. Instead, we're starting with this one massive clue: 32%. In a single quarter, one specific division inside Corning suddenly exploded by 32%. And finding out exactly why this segment grew so fast, that's the mystery we're cracking today, because it totally flips the entire narrative on this stock.
Chapter 1. The AI stock hiding in plain sight. So, to figure out where that explosive growth came from, we got to look under the hood at Corning's Optical Communications segment. This division pulled in over $2 billion in Q2 sales. That's that 32% year-over-year jump we just mentioned. But here's the real kicker. Look at the second bullet point. Its net income didn't just grow, it skyrocketed an amazing 77% to $438 million. This tells us they aren't just making sales, they're making highly profitable sales.
Before we pop the champagne on that number, though, we need to look at what's happening in the broader AI landscape to make this possible. When we think of the AI boom, we usually picture GPUs, right? Just immense computing power. But all that compute is basically useless if the machines can't instantly talk to each other. That communication requires light and optical fiber, which requires high-speed connectivity cables, which ultimately builds the whole networking infrastructure. So Corning, they've literally positioned themselves right inside the physical backbone of the AI build-out.
And they aren't just riding a vague trend here. They've locked in the absolute biggest players on the board. We're talking a multi-year, multi-billion-dollar agreement with Amazon to supply fiber and cable for their US data centers. On top of that, they just announced a long-term partnership with NVIDIA to expand their US manufacturing capacity by 10 times. 10 times! They are essentially building the nervous system of the entire AI revolution. Chapter 2. The $40 billion bet. So just how huge can Corning get if these AI data centers keep demanding this much product? Well, management rolled out this incredibly ambitious roadmap called the Springboard Plan. They are targeting $20 billion in annualized sales by the end of 2026, then stepping it up to $30 billion by 2028, and finally a jaw-dropping $40 billion by 2030. That is an absolutely massive goal for a legacy company like this. Chapter 3. The Profitability Puzzle. Now, obviously, a management target is not the same thing as guaranteed money in the bank. So let's check what Corning has actually pulled off so far. If you compare their standard accounting numbers to their core performance, which really gives us the actual everyday economics of the business, you'll spot a clear trend. Under the core column, sales hit $4.738 billion. That's up 17%. Core net income hit $680 million, and core EPS jumped 30% to 78 cents. So the underlying economics here are genuinely improving right now, not just in some future projection.
What's really fascinating is where these improvements are happening. Their core operating margin hit 20.9%, expanding by a full 190 basis points. That's almost a 2% jump, which is huge in this space. Core return on invested capital is up too. And maybe the most important piece, adjusted free cash flow hit a whopping $1.42 billion in Q2. That proves this optical revenue growth is turning into better business economics and cold, hard cash.
Chapter 4. The Solar Contradiction.
Okay, up to now, this sounds completely 100% bullish, until you see this next number hiding just behind the headlines. We know Optical Communications crushed it, but check this out. Corning's solar division actually saw its sales explode by an unbelievable 90%, hitting $438 million for the quarter. But wait, that 90% growth? That is actually not the number we should be focusing on. The real point is this crazy contradiction. Despite growing sales by 90%, the solar division still posted a $7 million net loss. Yeah, they lost money while almost doubling sales. So this brings up a super important question for anyone looking at this stock. Can Corning's future earnings actually rely on two totally different engines? Management says the solar division will turn profitable soon as they ramp things up, eventually targeting a $3 billion revenue stream. But what if it doesn't? If solar stays in the red, we really have to ask if that massive $40 billion valuation target becomes way harder to justify.
Chapter 5. The Valuation Warning.
Now, this is the metric that could honestly make or break the whole investment, especially if you're an income investor holding out for that solid $1.12 annualized dividend. With the stock price hovering around $150, Corning currently has a staggering $129 billion market cap. Let that sink in for a second. $129 billion. This is absolutely no longer a sleeper stock hiding in the shadows. The market knows exactly what's happening here.
So the question isn't whether Corning is growing. The numbers show they clearly are. The real question is, what happens if AI hyperscaler spending takes a breather? What if Amazon or NVIDIA hit pause on building these data centers? When you're buying in at a $129 billion valuation, you've essentially already paid a premium for all that future growth. If demand hiccups even a little bit, that premium could vanish overnight.
Chapter 6. The Final Verdict. All right, we've gone through the clues, the profit engines, and the cash-burning divisions. Let's tally up the final scorecard, starting with the bull case. And honestly, it is super strong. It's built on real margin expansion, that massive $1.42 billion in free cash flow, and clear-as-day optical demand from tech giants. Throw in a solid dividend, huge hyperscaler agreements, and a defined plan from management to double revenues. There is a lot to like here.
But let's look at the flip side. The bear case reminds us to keep our feet on the ground. When expectations are this high, there is literally zero room for error. Remember, AI infrastructure spending can be cyclical. It can speed up, but it can also hit a wall. Plus, that $40 billion figure, that's just a presentation slide target, not a guarantee. Add in the fact that Solar is still burning cash despite massive growth, and you have some very real valuation risks if you're buying at the absolute peak.
So here's the objective final scorecard. It is an aggressive buy if you are totally convinced the AI optical momentum is unstoppable and you're okay paying a premium today for tomorrow's growth. It's a solid hold if you're already a shareholder with a long-term view and you trust the management team to execute. It's a watch if you really like the business but want a cheaper entry point for a better margin of safety. And it's a sell only if you think the core AI data center thesis is starting to crack or if those nice margins suddenly start shrinking.
Because at the end of the day, it all comes down to this one thought. If Corning can translate today's crazy AI demand into years of sustainable revenue and free cash flow, that $40 billion target is a brilliant investment thesis. But if they stumble, or if the AI build-out slows down, are you just paying a massive premium for a future that never actually arrives? It's a fascinating puzzle, guys, and one that means we'll be watching those optical margins like a hawk in the quarters to come.